Hello, everyone. Thank you so much for joining today. My name is Dominique, and we have the rest of the Greenleaf team here. We have Dave and David joining us from all the way up from Chicago to discuss the state of North Carolina deal. As you may know, we do host our weekly live streams and private connect events every Thursday afternoon, discussing a sector of our business and really all things Greenleaf across all of our audience types. Today here we have our Oak Hollow 1031 investors here to discuss their replacement property in the state of North Carolina. And then later we will dive into really the opportunity here and to discuss this government lease. And without further ado, I will pass it to Dave and David.
All right, thank you very much, Dominique. We are excited to be talking about this one today. Also excited that David is joining us from Chicago, down here for a couple of days and celebrating not only taking this deal out, but we had a Henderson Mill deal that closed too. So pretty exciting, another government asset that we acquired. So for state of North Carolina, we rolled this one from our Oak Hollow sale that we just completed. And we are moving into a single tenant. As you can see it here, it's a 2-story brick building. It's exactly the kind of stuff we want to look to be buying. And yeah, we're very excited about it. So now think about this deal. We're buying it for $7 million.
Yeah.
So it's not too huge, but it's not too small on the other side. It's a good replacement for our Oak Hollow 1031.
Right in our sweet spot that we like to look for in the government deals. It's got a lot going for it. Mission critical, single tenant, the stuff that we're always searching for, but it doesn't always come together the way we want. We do different kinds of properties. So this is really one we're very excited about in terms of it having all the hallmarks of a perfect government deal.
And the best parts of when you say like, hey, we want it to be the hallmarks, the best part of that, what in your mind, what are we thinking here?
Well, single tenant is a big deal in the government world. And often we're actually pushed out of single tenant deals because government buyers will come and pay huge premiums for these type of deals. So generally we're doing more of the combined government with some other credit tenants or medical. Whereas here we were able to secure this complete off-market deal, not marketed, from an in-person broker relationship that we developed on our acquisition team through our regular presence on all of our target markets and just sitting down and getting to know everybody. And then someone saying, hey, listen, I know a guy, I don't think he'd sell, but you know what? Let me check it out with him. And that's what we call, that's what we call a Greenleaf deal, I believe.
Yeah, that sounds right.
Where there's no competition. We get to a price, the guy says, here's where I gotta be. We say, okay, here's where we can get to. We shake hands and have a nice, smooth transaction. So really excited about this. And also the building style really fits in terms of 2 stories. There's not some tall elevators you have to deal with. It's nicely maintained. It's fairly new, being built in 2012. So, and a very unique lease for government. Double net lease.
So it's a double net lease. And we'll dig into kind of the details of the structure and how the expenses pass through on that. But these are just a couple highlights of it. The rate bureau has been in this building since it was built as well. It was purpose built for that.
Yeah, which is another real key factor when you talk about the stickiness of government tenants overall. But when something's custom built for them, they'll build it out to their specifications. They'll pick a spot where they want it to be. They're limited by what their budgets are allocated, but within that, they're not looking and saying, oh, this is a better deal for us than others. They're just picking a spot and saying, here's where we want to be. Here's what we need. They're the only office of this state agency. So really picking their spot and wanting to stay there. And they have the ultimate situation. They could want ample parking. They didn't go into some space because it was available. This is how they like it. And they're happy to be there for an extended period of time.
Yeah, that's what the benefit is for us too. And we look at the map here of, we were talking about it a little bit earlier, of Raleigh, Durham, or just Raleigh. But
no, the whole region.
The whole region.
Raleigh, Durham, we were talking about, you throw a dart anywhere on this board, and if the numbers come together and it's a tenant we like you want to go grab it. It's just one of those regions that are so hot. I sit with brokers in Raleigh or Durham or somewhere in the middle, and one of them literally said, hey, listen, if you see anything that you don't want to buy, can you send it to us? Because it's such a tight market that even the local brokers are just dying for supply. Not a lot trades, but there's so much demand for it. So really any of these areas, Raleigh, Durham, Chapel Hill, Morrisville, Cary, are just areas that everyone's going after, and makes it a really exciting transaction for us to be able to say, hey, look, we're in Raleigh, outstanding area. Raleigh's the biggest growth area of the whole region. So really a trophy property
Yeah,
almost
it's
for
great
Greenleaf.
for us. And you can see the star that's in the center here, the white star with the green around it. That is the location of this asset. You see the bottom of the page down here in Clayton. We purchased another deal down there called Summit. And on the top left side, there are two of our VA clinics right by that Duke sign that's on the map. So this will be our fourth asset in this area. So we're getting pretty familiar with what's going on up here, and all of the other ones are VA clinics and medical base. And so this one being government is a good mix of
Yeah,
that.
fourth government asset alone in Raleigh-Durham. So it's almost becoming a hub for us in that asset class, which
Yeah.
is, again, in such a tight market, is impressive, and speaks to the strength of our team, really.
Yeah, finding this one definitely off market.
Yeah.
Impressive. All right, so state of North Carolina, we've gone through this a little bit too, just the amount of growth that they are seeing. You know, when we first started Greenleaf, we were investing in deals that were in Charlotte, and we got very comfortable with the Charlotte market. We bought a bunch of apartments in the Charlotte market. We expanded up there in commercial with our QOZ fund, and now we're getting into more commercial assets and then working our way up to the Raleigh area. Just as a point of reference, Raleigh is about 5 hours north of Atlanta, and Charlotte is around 3 or so. So it's kind of in the middle that we go there. That's really the main quarter that we are operating in. And I think everyone going in the basketball season right now knows that UNC and Duke are two of the biggest, not only schools, but employers, and the healthcare systems there are based around that in Raleigh.
Yeah, and you could see that the state of North Carolina is the second biggest employer in the county, in Wake County. And, they're really a key driver of the economic growth with their business-friendly policies. And obviously, as the region grows, the government's going to grow just naturally, but they're actually very supportive of the business. It's not just regulations and all sorts of those things are coming to take everyone's money with taxes. So, it's a nice cohesive relationship there with the business community. And Raleigh is in the top 10 of most move to cities, actually the entire Raleigh-Durham area. And they've had 25% growth in the last 10 years. So as there's that growth of people moving there for jobs, the research triangle, it really just continues to expand the government, which for us is what we're looking for here with this government tenant.
So North Carolina Rate Bureau, what exactly are they doing?
So they're regulating insurance rates across the board. They're a very unique state agency. A lot of states have this agency or this function, under a different agency. North Carolina, back in the 1960s, created this agency simply to regulate insurance rates, to tell insurers what they can charge for healthcare rates, for car insurance, for anything across the board.
All insurance.
Yeah, all insurance.
Any insurance rate is going through the NC Rate Bureau.
Yeah, they're overseeing it. They're telling the insurers what they're able to charge. They're also running state worker insurance out of this location. So they set the rates and make sure to set up plans for their state employees out of here. So a nice facility that's doing a few things, but this is the hub of it. This is, again, their only office in the entire state. So it's not like certain back office agencies where they could say like, oh, they have 5 of them, and maybe they'll move a little here and maybe they'll move a little there.
This is
their physical location for the entire state. So strong tenant.
So here we've got the area again. You can see our location with the green leaf on it, and the dark green leaf is what we're looking at here is the current one we're buying, and then the comps that are around here. So we're always trying to find comps, not necessarily that are, the highest dollars. We're trying to find the most recent transactions that are related to this asset type. And in this, we picked basically some middle ground here.
Yeah.
So we've got some medical, and then we have some office or non-government. And that's really the spread that we're operating within.
Yeah, and government is a bit of a challenge in terms of the comparables because it's a very undefined category. So as we do more of these government deals, we've done at least 6, 7 of them already. So we're really gaining a lot of experience in terms of where the market is for them and how to price them and how to value them. So what we find is there's definitely a significant premium over non-government, non-medical office, so general office. It trends towards medical office because they have the similar stickiness, the similar build outs like a medical office. So we're not ready to say it's completely comparable to medical office, but when we see something like this, that it's, right in the middle of the comps, we're very happy with that in terms of the government guarantee.
So we're looking at medical per square foot that is just over $300, and then another one at $360. Whereas office, non-government, I mean, this is traditional office spaces that traded in the 235, 245 range.
Yeah, and Raleigh and Durham in general, but even Raleigh more so, does have higher rental rates, which drives up the price per square foot, even on
Yep.
general office, where you see Raleigh is a market that's above Atlanta, above many of the other target markets we work in. But we could see that within the market itself, the property is very competitive. Again, 265 versus 245 for general office, the spread of $20 for a single tenant government entity, it's quite a small spread compared to what we normally expect. We would expect it to be, likely closer to that 300 to 350 range, closer to the medical. So very happy with where the comps are on this one.
So from a leasing standpoint, so that's what we're looking at on the sale price. And we said rates are a little bit higher here in Raleigh-Durham area compared to some of the other markets that we're operating in. To give some idea on that, a full service lease, some of our full service office-based leases in Atlanta are in the $15 to $18 range. And then our medical leases are in the low to mid 20s. Chattanooga is a little bit higher than that because there's not as much product there, but this one is the highest really that we're seeing.
Yeah, and we have a lot of experience in the market, even though we haven't done any medical deals yet. Hopefully we have one or two in the pipeline, but just looking at all those deals, we're very familiar with the lease rates. This one has a very unique double net lease, which is unique for office, it's unique for government. So we see here, even when we factor in what would be our normal operating costs that we don't have to do here, we don't have to run that management, you could see it's still significantly below what a full service lease runs for in this market.
Yeah, when we look at lease comps and we're saying a full service lease means we are covering everything. So anything happens, tenant calls us, our maintenance team, our support team goes out and helps solve that problem. Everything from a leaking roof to a light bulb that needs to be changed. And a double net lease, we're not doing a lot of that work, but we still have some responsibility. So we're still handling the building and the roof.
But you don't have to go for light bulb.
But nothing on the inside, basically. We're the outside.
It's really major issues. It's very similar to the Dollar Generals we see actually, where we almost treat it like a full triple net lease in the sense that, if there's a roof leak or a roof replacement that's required, which we don't anticipate a lot of here with a fairly new construction building in 2012. Yes, we'd have to fix that if there's a structural issue. But on this property, really, besides that, anything in the building, even the janitor that cleans up or sweeping the parking lot, they have to do all that. And that's really, really unique, especially again, for office and all the more so for government office.
And our typical operating costs, if we're looking at between $450 and $650 a square foot for operating costs, if you were to add that into our per square foot rental rate here, you'd get more into the full service lease rate that you see here. So by us having a lower rental rate here, that's because they are assuming that operational cost on their end and paying us a little bit less in rent.
Of course.
So overall on this investment, we mentioned in the beginning about $7 million is what we're purchasing it for. David, you'd spoken about that there's not really any CapEx that we're doing in the upfront here. We get our number here, capital improvements of $13,000. We hire an engineering firm and they go out to the site and they do a deep dive into everything that's going on with the building. And we take our first 2 year of findings, so they will phase out between 1 and 10 years of all the costs that they can find that's wrong with an asset, and they always find something. But on this deal, they found about $13,000 worth of items that had to be fixed in the first 2 years. So we plan to do that. We have our closing cost reserves. It puts us in all at $7.38 million.
Yeah, extremely limited on that CapEx, mostly a few bushes that need to be fixed on the landscaping and a couple small parking lot, just if there's a crack in the parking lot, which for an office property is basically zero.
Yep.
Just well maintained, good shape. And again, even if it's not necessarily on the inside, but unless it's roof or structural, it's not our problem.
It's not
So
ours.
that's one of the big things we love about this deal.
So going in year one, we're looking at an annual cash on cash of right at 7%. But going out to year five, we're going up to 9.7% with our rent escalations. Now, in the middle of this, we're always, every deal we do, we're always trying to find some form of a value add opportunity. And what we got with this NC Rate Bureau deal is that there's currently a 2.5-year lease that's on the asset. They had signed when they purchased it a 10-year lease. They extended after that, and now we're going to work with them to go to the next really 5 to 10-year lease. We'd be aiming for a 10-year lease. That would create the most amount of value on this deal. So that is our strategy going forwards. Really, we have time to work through that, but we'll be working with them really once from when we take over to prove to them that we are a good operator, have a good relationship with them, and get them to sign that long.
And they've already indicated that they want to do that. One of the nice things is often we'll see on government deals, especially where they'll do shorter extensions, especially through the last 2 years, where a lot of them were told, hey, don't sign any long extensions until we see where everything's going financially with all the recent concerns. But here they've already told us, hey, listen, we were ready to sign a 10-year lease. They have some change in administration that they wanted the new administrator to be able to sign the longer term lease so they could tailor it to their vision for this state rate bureau. But they've already expressed to us like, hey, listen, we're signing a new 2-year lease, and in 2 years, we're going to sign a new 8 years. Now, obviously, that's not guaranteed because anything can change until a lease is signed, but it's even stronger than a lot of properties we go into that they say, oh, we're thinking of signing a new lease. And based on tenant interview and limited competition options, we're comfortable with that. But in this case, we actually have where they have said to us, yeah, we're going to sign a new 8-year lease with you. And the annual escalations are really nice. Many government properties have flat rent or they have a bump every 5 years, whereas we have the ultimate flexibility here with actual 3% annual escalations. The 3% a year is a very high escalation rate, especially for a double net lease where we're not covering a lot of the expenses. And that flexibility is always something we look for, where we can say, okay, listen, if we want to sell right after the renewal, we don't have to wait for some rent bump that's going to kick in later and worry that we're losing money. On a yearly basis, we can look at the exact numbers and say, okay, we're ready to sell this if that's what comes to pass.
Yeah. 3% is about the highest that we see in commercial leases on an annual escalation. I think we have some that are about 3.5%.
And usually you see it for smaller mom and pop tenants that they need to compete
ones
for the space, but the bigger tenants will come and say, hey, listen, for getting me in here, I want flat rent, I want 1% a year, I want no increases, but I'll pay you CPI expense increases. So to have it where they're covering all the expenses, so essentially we're immune from expense increases, plus a built-in 3% lease is a really unique and exciting type of lease
with
for a
fixed
government
debt.
tenant. Right.
So our debt is fixed in this deal too. So that's very good.
Yeah.
So cash flow and returns on this, we're always looking at what does a typical investment look like. We use $100,000 increments just for a nice round number. It makes it easier for all of us to do the math, especially when it's on the fly sometimes in a conversation. But if we look at this at $100,000 initial investment, we spoke 7% cash on cash is year one. And you can see how that grows year over year. And we're projecting in year 5 that we would have an exit. We are projecting at a lower cap rate than we're currently buying it for. So we're projecting an exit at a 6.5 cap. The reason for that is if we exit in year 5, everything goes to our plan. We will have at that point, a 7.5-year lease remaining on the asset. So we're buying it with about 2.5 years left, and we'd be exiting with 7.5 left. So that's why we feel there will be a reduction in the cap rate at that time. You can see our overall deal IRR at that point pegs us around 17%.
Yeah, and in general, we're very conservative on exit cap rates and what we project. We really aim not to add in a lot of projected appreciation because we're not swamis. We don't predict where cap rates are going to go. And a number of investors have actually told me a few times, we're one of the only groups that will publish our exit sensitivity tables. And it gives them a lot of confidence in our underwriting. But in this case, being well versed in the government world, we have government brokers who are actively trying to get us to buy similar properties that are single tenant, stake backed from the strongest among the state guarantees. North Carolina has all the top ratings. It's a great business state, great market. And they're telling us that these properties are already worth 6 caps in the current market. So when we project in a lower cap rate, we're doing that from a position that we feel the property is already being sold to us in an undervalued state, but we still won't take it, all the way to that 6 cap. We'll cut it in half and say we'd rather be conservative.
And in our sensitivity here, we can see going up to 7.5% on an exit cap rate. We still have a 10% IRR and a 1.5 equity multiple. So if it comes to that and we do see cap rates go the other direction, we still have a little bit of room going up. And then if they continue the trend where they're at, and especially the demand for the government single tenant leases, we're in very good shape. Okay, that is it, folks. Thanks for watching on the North Carolina Rate Bureau. We are going to turn it over to Natalie here and Dominique, and we're going to go through some questions that we have on this asset and what we're seeing in the government space.
Right. Thank you so much, Dave and David, for providing those insights for us regarding the NCRB, or North Carolina Rate Bureau. Before we dive into that Q&A session, we wanted to provide some quick reminders for our committed investors. You can expect your subscription package to be delivered to you via email by the end of the week next week. That's March 29th. We ask for your subscription as well as funds to be collected and submitted by April 5th to prepare for a closing of April 12th. With that being said, I will ask Natalie to start our Q&A session.
Great. Thank you, Dominique. And thank you to everyone who submitted questions today. So first question for you guys, how did Greenleaf locate this deal?
That's a good question. What do you think here, David? David's been leading our seek for government assets really over the past year. And that involves really trying to talk to as many people as possible. Yeah, I would say is step number 1, talk to as many people as possible.
Yeah, it's a big success story. And really, our acquisition team works very strongly together in this way. Obviously, we're each handling our own asset classes, but our, presence already existing in those markets, but combined with the fact that our acquisitions managers are really in those markets on a regular basis. So we're meeting with people see our faces, versus a lot of more national groups that are saying, hey, we'd love to buy in your market, but they never show up. They don't even go visit the properties. So this was a property that on one of our regular travels through the Raleigh and Durham area, and really all across the corridor, or all through the corridor. So there's a broker that we have an established relationship with. We had not worked with before, but I had been talking to him probably for about 2 years. And we sat down and we sat down and we sat down. And about the 3rd time we got together, the broker's like, wait a second, did you buy this property? Like, I think I know the owner. I think it's a government entity. Would you buy it? I'm like, yeah, we'd love to look at it. Like, send it along. We look at everything. Yeah. And it really came just through that. It wasn't someone looking to sell. It's an old family holding, which usually works out quite well for us. And the owner said, yeah, I've held it since we built it, or since it was built. And yeah, if they can get to this price, like, we're happy to do it. And the nice thing is, I don't know if you'd call them real estate professionals or not. They're a little more professional than some of our sellers, but they weren't looking to say, hey, I want to put this to market and gouge the last penny. They're like, here's where we would be happy. We want a strong buyer. We don't want to go through a whole process. And they were very happy with us as buyers, of course, as well.
Yeah, we make our execution of acquiring a deal as smooth as possible, really for all sides. We want it to be smooth for the seller. We want it to be smooth for the broker. And we'd love it to be smooth for us as well. But the better we make that process and the experience for everyone, we're very conscious of that. And that just facilitates us getting more opportunities to continue to do that in the future.
They say the best way to get more properties is to close one.
That's true.
So yeah. I have about 3 brokers. We have about 6 deals under contract right now across the asset classes I handle. And I have about 3 other brokers saying like, hey, I got a lot more for you. Let's close this one. I'm like, you can't send them to me now. They're like, let's close this one.
Yeah.
So looking forward.
So David, you touched on the state's renewal plans a little bit, but can you discuss in greater detail their plans here and how you see those negotiations going?
Yeah, we modeled this property to continue with the 3% annual escalations that they've done to this point. Our goal is not to rock the boat. Our goal is to keep them happy. Obviously, they're happy with the lease structure they have, which is evidenced by the renewal that they just put through. And they're openly telling us, hey, we want to re-up for 10 years here. We have nowhere else to go. We love the location. It's a location in Raleigh that's convenient for most of our workers. It's a large parking lot, which if you look on Google Maps is quite full. So they
It
have
helps. Yeah.
a lot of people here coming out of this agency and they're not looking to go anywhere. So when someone will openly tell you, hey, we're very happy with it, we're renewing for 2 years, we want to leave the longer renewal to the new administrator coming in because the gentleman who handles it is retiring, which is actually common in government spaces. I've had a few of our properties tell us, hey, listen, I'm retiring, so I want to leave the renewal to the new administrator, so I'm not just sticking him with something. But, so they're very happy with this property. They're looking forward to a long-term tenancy. Again, we've discussed that government tenants have an average tenancy of 23 years across the board. So a newer property that's custom built for them, they're very happy with it. And we don't want to rock the boat. Our goal is to retain them and go to them and say, hey, listen, you have this lease structure. Clearly, you're happy with it. You have these annual escalations. Clearly, you're happy with it. Just sign on. We're not looking to jack up your rental rates. We're not looking to change the way you've been doing things. We're just here to be a strong owner for you and keep you happy with the place.
Now, with that being said, is there a risk that the renegotiated lease is both short-term and in a non-double net annual 3% escalation structure?
So the short-term lease is the same structure that they've had until now. They literally just said, we want 2 years of this identical lease. They didn't even, I don't even know if they went and wrote a new lease. It might just have been an amendment saying, hey, we're signing on for 2 years with this.
Yeah, just keeping the terms and say, let's just add another 2 years.
Right. So that's what they did until now. And, should a new administrator decide, hey, listen, we'd rather have a full service lease, we're very comfortable in those lease rates that if we had to build in those expenses, we would be able to renegotiate at a rate that we would be happy with and they would be comfortable.
But there's also that risk that they simply say, hey, we just would prefer just another short-term 2-year lease.
Yeah.
And with that, if something like that happens, we're really not going to see the value increase that we had projected, driving us down to the 6.5 cap rate. It's pretty much if they just continually sign additional shorter term leases, the value is pretty much just what we paid for it today.
Yeah,
we're not going to see really a change in cap rate based on the lease.
Right, but we would still have some nice appreciation in the price based on those 3% annual escalations, rather than other properties we've seen that have flat rent and people come back and say, hey, can we just extend a year while we're deciding what we're doing? And then they keep extending for a year.
That's flat rate.
Right, so here you have that protection. And again, we don't have the expenses to bear, so we're not looking at any inflationary risks in terms of what it would cost us to manage the property.
Our next question, can you discuss the loan terms with us?
Go for we can go back and pull up the loan.
3.4%. 3.4% is one of the reasons we love government. And when I started with the government sector, and even back to when I was only handling retail, and Josh was talking about government, I'm sure you were too, Dave. Look where financing is. Look at the spread that we can get. We have gotten, even with rising interest rates, that the banks are not only factoring in the rising interest rates now, but they're factoring in the next 6 increases. We were still able to secure a 3.4% fixed loan here, where even on our retail properties, they're already pushing 4% on those. So just that spread really makes for great returns on these type of properties.
3.4% right now is fantastic. And that's really driven down just because of the government or the NC, North Carolina credit.
Yeah.
But all the other assets we're looking at right now are in the higher 3s. So we're saving about 40 to 50 points off of a loan we're seeing in other asset classes because it is backed by the state of North Carolina.
Yeah, and that's a key driver of our entire government strategy, is that there will always be that spread where the banks have the confidence in the state to pay. And that's really how we're able to buy such stable properties, but still get the type of returns that our investors are regular to and looking for.
Great. Well, those are all the questions we have. Again, we want to thank everyone for participating. And of course, we want to thank Dave and David for sharing the details of our new state of North Carolina deal with us. As we wrap this up, we'll pitch it back over to Dominique to close out with our upcoming dates.
Yes, thank you again so much for joining us today. Really, this is a friendly reminder that as we wrap up our end of quarter, we will be announcing our end of quarter reviews along with property updates April 20th, which is rapidly coming upon us. So be on the lookout on your inbox, as well as our invested investors get a text message when those become available. We will be hosting some sort of Greenleaf Connect event associated with those property updates as well that we will all invite you to. Well, thanks again. This does conclude our regularly scheduled program. This is a friendly reminder that this live stream was recorded and will be shared with you by the end of the week this week. We hope you have a fabulous day, and we look forward to seeing you soon. Bye-bye.
All right, thanks everyone for watching. Appreciate it.
Thanks.
We're excited about doing this one. This is going to be a great one.
Oh, yeah.
It's like find as many more as we can.
I would do this with you every day, Dave.